In this chapter, what we're going to be doing is going over Chapter 10, looking at the idea of life insurance, something that a lot of folks have some questions about, may not understand, that sort of thing. You can see the chapter learning objectives, okay, define it, what are the different types, think about the provisions, and things like that. Now, life insurance is basically where you are betting that you will die, okay, before the insurance is up or before a certain time. And the insurance company is basically taking that bet. So what's happening is you are buying this insurance policy that says, okay, I'm going to pay this, and then if I do die, then you're going to pay whatever the par amount of the insurance is going to be. Now, there's differences, there's reasons for it, okay? So in other words, maybe you got a life insurance policy to pay off a mortgage that you may have. Or maybe what you want to do is provide an endowment or schooling for your kids and things like that. The whole idea behind this is to protect someone else. In other words, family members, spouses, kids, parents, things like this. And so what you're doing is you're actually providing some protection for others in case you pass away. Now, the way it's set up as far as how it costs, the costs that are set are based on mortality tables. And what you do is you're basically paying a premium, which might be a monthly charge, maybe a yearly charge, or something like that. The mortality tables are basically saying, okay, here's how long you are expected to live at that point in time. So in other words, if you're 25 years old, you're expected to live another 52, 53 years if you're a male, about another 57 years if you're a female. And as you can see, as you get older, once you hit like 70, you're expected to live maybe another 14 to 16 years. And so what they're doing is they're saying, okay, based on mortality and how long you're going to be paying into this, this is how much you're going to have to pay for that. So in other words, if the sooner that you can buy life insurance, the younger you are, the cheaper it's going to be. Now, if you think about it, do you need it? Okay, well, if you have anybody who is relying on you financially, you should have some sort of life insurance. Maybe you're single and you have a lot of debt. You have, maybe you've already bought a house, you have a car, you have a lot of credit cards or something like that. You probably want to get a life insurance policy to cover that. Now, how much should you get? Really, the best way to think about it is the easy method, okay? So it says, okay, about 70% of your salary for 7 years. And so let's say that you're making, $50,000 right now. 70% of that would be $35,000. $35,000 over 7 years would be about $245,000, about $250,000 in life insurance. So if you're working, you have a family, and you're making about 50 grand a year, you probably want to have about $250,000 in life insurance. There are other ways of calculating it. In other words, the dual income, no kids, the non-working spouse, or the family need method. You can look those up in the book. The easy way to do it, the best way to do it, is just think about the easy way as far as how much you're going to need. That's the easy way to kind of figure out how much to get. Now, there's two types of life insurance companies. You have your stock life insurance and your mutual life insurance. What happens is stock life insurance is actually owned by shareholders. In other words, people buy stock in the company. Mutuals are owned by the policyholders. You buy a policy, you are one of the owners of that company. For example, stock companies might be MetLife. I'm sure you've seen the commercials for MetLife, or maybe Prudential. Those are stock companies. You can buy stock in those insurance companies. Now, mutual companies, examples might be New York Life or Mass Mutual, Massachusetts Mutual. Those are mutual life insurance companies where you buy a policy from them, you're actually one of the old owners. Now, they talk about participating and non-participating. That means participating in the profits. With a mutual life insurance company, when they have profits, you get a portion of that back. They send that back to you as a dividend. That's participating. With the shareholders in a stock life insurance company, the shareholders are actually getting any kind of dividends. You, as an owner of a stock life insurance policy, do not participate in any of the earnings. Stock life insurance policies are cheaper than mutuals because of the participating in the profits. Most of the life insurance policies are sold by stock life insurance companies. About 3/4 of the policies that are out there are from stock life insurance companies. The other quarter is from mutuals, where you're participating in the policy dividends and the profits. Now, there's different types of life insurance policies. You have whole, term, group life, and then you have credit and endowment. Most people are more concerned with these three right here: the group, the whole, and the term life policies. Now, term life means that you have bought a policy for a certain term or a certain number of years. It might be 5, 10 years, 10 years, 15 years, whatever it is that you decide. During that time, you're paying the same premium throughout. And what it does is it covers you for that amount of the policy for that time. Once that term is up, it's over. And you have no cash value as far as that's concerned. It's pure protection, all right? Pure protection. You stop paying the premiums, and the policy goes away. Now, there's different types. You have renewable, multi-year, conversion, things like that. Check it out in the text as far as what some of those differences are. Whole life or straight life is where you will get this policy and it will be enforced for as long as you want to keep paying the premiums on it, and those premiums are not going to change. This is why it's best, if you're going to buy life insurance, buy it early, because it's going to be much cheaper. Because you're going to live longer, you're going to pay into it longer. What it does is it will provide the death benefits just like a term policy, but it accumulates a cash value. It's not that much, okay? You're not going to get a heck of a lot of a return on whole life policies. You'll get a few percentage points. It's better than a savings account, and you do build up some of that cash value, but it's not a good investment type of thing. The returns are fairly low, but you do have the cash value, and you can borrow against that cash value. So let's say that you have a $100,000 policy, you've had it for a number of years, and let's say that you have, maybe $15,000 in cash value. You can borrow some of that to maybe finish off a basement or something like that. Now, you do have to pay it back. The thing is, you do have some of that. Now, let's say that you decide to cancel, or you're no longer going to use that whole life policy. You will have cash value that will be returned to you. So some of the options you can have limited, variable, adjustable. Check it out in the text as far as some of these differences, as far as the different type of whole life policies you can get. Now, group life insurance is the cheapest that you can get. You start to work someplace, one of the benefits that they typically have is life insurance, and it's a group life insurance policy. Most companies will give you free a certain amount of life insurance, okay, covering you, and you can identify who your beneficiary is and things like that. It's typically maybe 1 or 1.5 times your salary. So let's say that you're making $50,000, you're working someplace. They will typically have, as a part of their benefit plan, a $50,000 group life insurance policy. Most of them will then allow you to buy more of that group life insurance policy based on the number of times of your salary. So let's say that you decide, I'd like to get 3 times my salary in group life insurance. So you get $150,000 in group life. You'll have to pay for the other $100,000. The thing is, it's going to be much cheaper than any of the term policies or the whole life policies that you could possibly buy. Credit life insurance is, let's say that you're getting a loan for someplace, like you're going to get a car loan. They'll try to sell you credit life insurance. In other words, if you pass away, if you die, then your loan's going to be paid off, but it's really pretty expensive. This gives you the differences between term, whole, and universal life, where the premiums come from, the benefits, the advantages, disadvantages. Check that out in the text. Now, there are different things as far as the life insurance policy that we have to think about. First of all, who's going to be the beneficiary? One of the things that you want to do, let's say that you're married, you want to identify your spouse as a beneficiary. Let's say that you want to identify your parents as the beneficiary. You can do that. The incontestability clause says that after a certain length of time, the insurance company is not going to contest the validity of your policy. So, for example, after several years, they're not going to challenge how old you really are. Say you lied about your age to get a cheaper policy. They're not going to challenge that after several years, things like that. They'll also have a grace period for late payments. In other words, if you're not paying on time, they're going to cancel the policy. They have a grace period of a certain number of days. Understand what that is. They may have a non-forfeiture clause. In other words, okay, once you have had a whole life policy and it's started to build up the cash value, once you cancel that, you get your cash value back. You may have a policy loan provisions where you can borrow the cash value, that sort of thing. Suicide clause during the first 2 years. They typically have that, which says, okay, if you commit suicide within 2 years of buying the policy, we're not paying it off. After that, they may pay it off. It just depends. They also have some other things in there, like waiver of premium disability. In other words, you're in an accident and you are disabled, you won't be able to work anymore. There may be a waiver of premium. You keep the policy, but you don't have to pay the premiums anymore. Another life insurance policy rider might be the accidental death benefit. In other words, if you are killed in a car accident, okay, it's accident, they'll pay double what the policy amount is. So if you have a $100,000 policy, it has an accidental death benefit in there, let's say 2 times. If you're killed in an accident, you get your beneficiaries get $200,000 in life insurance. Guaranteed insurability option. In other words, if it's a term life policy, it may have a rider in there that says, okay, you can renew it and we guarantee your insurability, things like that. So there are various things that you can add to your policy. When you're buying life insurance, also think about what kind of sources of income you're going to have in the future. What group life insurance policies are you already carrying? Things like this. So be thinking about what kind of income that you're going to have and how much you're actually going to need. You don't want to buy too much, but you don't want to buy too little. And so you have to kind of plan some of those things. When you're thinking about buying, check out the companies that you are buying the insurance policy from. These are some areas, AM Best, Standard & Poor's, things like this, that do analysis on the various life insurance companies, or all the insurance companies, as far as how strong are they financially, how do they pay off their policies and things like this. And they will rate the various companies based on those things. Another thing to think about is who your insurance agent is. Okay, insurance agent and the person that you're dealing with is really important. So ask around, okay, and shop around. My insurance agent works strictly for State Farm, and my agent has actually been a friend of mine for a number of years. Our kids grew up together. And so I have all of my insurance with him, and he sells only State Farm. There are other insurance agents who actually will sell insurance policies from different types of companies. So you just have to understand what it is that insurance agent is doing, and are they actually working in your best interest. You want to make sure that you do compare the various policy costs and things like that. Shop around as far as some of the things that are doing it. When you are thinking about getting life insurance, first you have to apply. Okay, you have to put in an application for it. And one of the things they'll do is ask about medical history and ask you to take a physical exam. You don't need a physical for a group policy. So in other words, you go to work someplace, they have a benefit as far as the group life insurance. You don't have to take a physical for that. When you start thinking about your policy, you also have to think how it's going to be paid out in case they do need to pay it out. Is it going to be lump sum or limited installment? These are the two that are typically used. You also may have a life income option, or maybe you're going to leave the proceeds with the company for a certain length of time and then all they're doing is paying off the interest, things like that. Normally what happens is most times people get the lump sum payment. A lot of people will ask, okay, should I be switching policies? Well, only if the costs make any sense, okay? And are you still insurable? Okay, if you have an insurance policy and all of a sudden you're not insurable because of some issues that you've run into as far as health issues, probably be best to keep the one that you have. Now, another type of policy is what's called an annuity. All right, it's a contract where you are paying monthly into this particular policy. Up to a certain point, it will then start paying you back. So, for example, let's say that you buy an annuity at age 30, and you're paying into this all the way up until you retire at 65. At 65, you can start drawing on that and paying yourself back from some of the things that you had put in and saved, and then also the investment increases that came from it. First of all, one of the things you want to do is make sure you fully fund your 401ks and things like that before considering it, because annuities aren't that great an investment. What it does is it provides you some income for life, all right, and you do get compounding interest where it grows, and you don't have a maximum annual contribution. Now, you typically have a maximum annual contribution as far as your IRAs that the IRS says that you can have. With an annuity, you don't have that max that as far as the limit is concerned. And there are different types of annuities, okay? You can look those things over and think about what they might be. And there are various costs that go with annuities. Again, annuities are not the best investment in the world. Probably want to make sure that you just make sure that you have regular life insurance, and then you're thinking about the other investments and things that you're doing. There are tax considerations that come with annuities. Just be familiar with that. So some of the summary as far as the chapter is concerned. Think about what life insurance is and how much you're going to need. There's different types of life insurance companies that will provide the various policies. Stock insurance companies are cheaper, mutuals are more expensive, but you participate in the profits from that. You have term, you have whole life, and different variations and combinations. If you have a question, give me a shout.